Hey guys, Jeff Lipple. Today I wanted to talk to you about something that is really interesting and really exciting. I want to talk to you about syndication. Usually this is used when purchasing large properties like apartment complexes that have larger purchase prices, and you typically need multiple investors to get involved to pay for that property. But recently, a couple weeks back, I went to a meeting with Dylan Borland of Borland Capital and his partner David Tupin, and they did a great job on explaining it. It can be a very complicated process, and there's a lot of different ways that you can do it. So today I was just going to scratch the surface just to kind of make you familiar with it, and then you can research it further or reach out to the Borland Group if it's something that you're interested in getting involved with. So I think the easiest thing to do is just go through a fictitious example of one. And again, there's many different ways to do this, and you also want to consult professionals like tax accountants and attorneys, having a legal team to structure it properly. But like I said, I'm just going to go through a fictitious example to give you an idea of how syndication works, and then it might be something that you want to look into further. I'll show you on the whiteboard where I wrote it out, and we can go through the numbers. So let's use an example of a 32-unit apartment. It has a purchase price of $1 million. The bank is willing to lend you 70%, so $700,000 based on the income of the property. And that means you'd have to raise $300,000. So what we're going to talk about is raising that $300,000 with private investors. Assumed numbers here: operating expense of $100,000, a net operating income of $120,000, and a net income of $53,000. So typically when you're finding investors for these properties, you'll give them something called a preferred rate of return. So in this example, we'll use 8%. So a lot of investors would be happy knowing that if they passively invested their money, that they get an 8% preferred rate of return. So basically what we're saying is if we need to raise $300,000 and we're going to pay 8% on that $300,000, then $24,000 is going to be paid in interest to our investors. Now the nice thing about purchasing these properties in the syndication deal is it also gives your investors equity in the deal. So in this example, we'll use 70% ownership goes to the investors and 30% goes to you, the purchaser of the property, the one that found the deal and is structuring this all. In this example, again, there's many different ways to structure this. This is just one of many ways, but we'll say that anything that's earned above 8% on this property will be split between you and the investors. Again, they'll get 70% of that and you'll get 30% of that. With our net income being $53,000, if we take out the $24,000 paid to our investors, which was the 8% on their initial investment of $300,000, that leaves us with $29,000 in profit to split between ourselves. So of that $29,000, 70% goes to the investors, which is $20,300. So $24,000, that equals a total return of $44,300, and divided by their investment of $300,000, that gives them a 14.8% return for the year. Now, as I'm sure you know, most investors would be thrilled with 14.8% return on their money, especially with a passive investment like this. I know at my credit union currently they're advertising CD rates at 1.35% per year, and with 30% of that going to you, of that $29,000, 30% of $29,000 would be $8,700. Now, where it can get as exciting for you as the person that's putting the syndication together is there are different fees that can be charged. For example, an asset management fee of 1%. On $1 million, 1%, that'd be $10,000. So not only do you have your $8,700, but you have an additional $10,000 coming in from that. And there are other things like a 3% syndication fee that you can have. And these deals are really structured however you want to structure them. You know, you have to stay within the rules, but you can have these fees, and the fees can be different percentages, or you don't have to have them, and you can have smaller or larger equity splits. But kind of gives you an idea is where it can get exciting for you as the person that found the deal and is putting it together. And again, your investors are thrilled because in this example, they're getting paid over 14%. Even if they get 8%, typically most passive investors are pretty happy seeing that on their money. And then the other cool thing is with them having equity ownership in the property, say for example after 5 years you were able to sell the property for $1.5 million because maybe the building was in rough shape and you did some renovations, or maybe there was a lot of vacancies and you got all the units filled. But if at the end of those 5 years you were to sell it for $1.5 million and had a profit of $500,000, again, you could split that between you and the other investors. So 70% of that $500,000 profit would be $350,000 paid to them, and 30% of that going to you would be $150,000 profit for you. So not only are you getting that great cash flow and rate of return each year, but you're also getting a big payday at the end of it. And another thing that you could do is just do a cash out refi to pay off your initial investors and own the unit outright. You'd own 100% of it yourself. 32 unit apartment building where you just didn't necessarily have to put any of your own money into the deal up front. So I thought this was really interesting. Again, I just wanted to scratch the surface with it. You get the idea of where it can be really interesting, and you can see how you can purchase very large properties, whether they're $1 million or $5 million or $10 million, it doesn't really matter. It's just a matter of you finding the property, doing your due diligence, and structuring the deal that's a win-win and beneficial for everyone involved. What I'd recommend if you want to learn more about it is reach out to Borland Capital. Also, Josh Sterling, another local Metro Detroit investor, did a couple different podcasts on this. So here I went ahead and wrote out all the numbers just so you could see them all together in one place. In the example that I used, again, this is just a fictitious deal, but just to give you an idea how some of these numbers work. You got a purchase price of $1 million, bank loan of $700,000. You're raising $300,000 from your investors. This is a 32-unit apartment. Annual income of $220,000, operating expenses of $100,000, leaves you with a net operating income of $120,000. And if the net income is $53,000 on the property, you can see how some of this plays out. If the investors are getting paid 8% of a preferred return on their $300,000 that they invested, that's $24,000 paid per year. And if you're splitting anything above 8%, 70-30, that gives you $53,000 net income minus the $24,000 that's paid from the 8%. $29,000 is what's left over above the 8%. If 70% are going to the investors, that's $20,000, $300, plus the $24,000 from the 8% equals a total amount paid to your investors, $44,300 for the year. Divided that by their initial $300,000 investment, that's where you get that 14.8% rate of return. And if, for example, you were to sell it in 5 years for 1.5, you know that you're profiting $500,000, which means $350,000 for your investors or $150,000 for yourself, or do a cash out refi, pay off your investors, and then just own the property outright. And like I said, there's other type of fees that you can add to this deal. For example, 1% asset management fee would mean an extra $10,000 for you. A syndication fee of 3% would mean an extra $30,000 for you. So a lot of different options. Hopefully seeing all these numbers together gives you an idea of how it all works. Very interesting. Something that you might want to look into more in the future. All right, everybody. As always feel free to reach out to me with any questions, and hopefully I'll talk to you soon.